The asymmetric portfolio is up 48.5%, crushing the market's 12% returns. And the strategy that I'm using is relatively simple. I buy stocks every single month. I don't day trade. I rarely sell, but I'm buying stocks with asymmetric potential, 10x potential over the next decade. I'm holding them long term. I'm letting my winners win. And that simple strategy and mindset is what allows me to beat the market by a wide margin. Today, I'm going to go through 3 companies that have driven those returns and the one stock that I am investing heavily in 2025 because it has phenomenal value and phenomenal growth potential long term. If you want to see how I beat the market and get all of my research, sign up for Asymmetric Investing. The link is on the screen, and there's also a link in the show notes. That's where I cover every single stock that I'm buying every single month. I tell readers what I'm buying before I buy them. I do deep dives on every single stock I own, and I give regular updates on those positions and how I'm thinking about their operations and their strategic performance long term. So stay tuned with everything I'm doing there. And I want to thank this video sponsor, FinChat. FinChat's the research tool I use for everything here on Asymmetric Investing. You see it throughout my videos. I use it all the time on the newsletter. It is a phenomenal research platform with information about tens of thousands of companies all around the world. Everything from fundamental analysis, income statement, balance sheet, cash flow statements, all just a few clicks away. And the great thing that they've added recently is artificial intelligence interactions with transcripts. Now I don't have to go through transcripts and listen to or read an hour-long conference call. I can go through and just ask questions about what happened in that conference call. What are the few things that I'm looking for? That's how they're using artificial intelligence really simply at FinChat. If you go to finchat.io/ASYM, you can try it out for 2 weeks for free. That's the pro version. That's what I pay for. Yes, I am a paying customer of FinChat. If you like what you see there, you can get 15% off with that link. So check that out if you're into more research. Let's go through what's driven the asymmetric portfolio over the past year. And the biggest holding in the portfolio is actually a stock that I haven't bought in quite a while. And that is Spotify. But you can see here, look, this is the 5-year chart for Spotify. Asymmetric investing started about 2 years ago. So I started buying shares right about here. And you can see that the returns over 400% since April of 2023. But this has been a massive driver because I've just allowed this investment to compound over time. Over just the past year, the returns for Spotify, company that you may not see a lot in the news, 123.4%. Just phenomenal returns. Now has a $143 billion market cap. It is getting pretty expensive. That price earnings multiple over 100, even on a forward basis, the price earnings multiple is over 60. But what's changed for Spotify is the operations. And this was really the thesis behind investing in the company in the first place. Spotify has been a steady growth company for quite a while. This is the premium revenue in green and ad-supported revenue in blue. This is the KPIs you get on FinChat, just a phenomenally useful tool that I use all the time. And what this shows is just that continued steady growth that you get with Spotify. What has changed over the last few years is the profitability of both their ad-supported business. That's in purple. That's still a pretty small business, but it's starting to be at least positive gross margin. That's nothing to sneeze at when this is a business that has struggled to make money for years. But the premium business is starting to be much higher margin. I'll get to their margins in just a second. But if you move this to, let's go to 2021. The revenue from premium has compounded at a growth rate of 17.6%, but the premium gross profit has increased at 22.5%. So operating leverage is working in Spotify's favor right now. That has helped 2 things rapidly improve for Spotify. One is their gross margin. This is going to be just how much money are they going to make on each one of those subscriptions. One of the things that I think investors are always concerned about with Spotify is their gross margins are capped because they do have to share some of their revenue with artists and record labels. So they're not going to have a 70-80% gross margin. That's never going to happen in this business model. But they have pushed that gross margin up to 31.2% over the past year. These are all trailing 12-month numbers. That is a 6-point improvement from 2023, just a phenomenal improvement in the gross margin. And they've also contained their operating costs extremely effectively. Going back to the pandemic, this was always a company that was focused on growth. They spent a lot of money on marketing. They had negative operating margins. You take out stock-based compensation, they were usually generating a little bit of free cash flow, but they were diluting shareholders at the same time. That has really stopped because they've been able to improve their margins at a rapid rate, now a 10.8% gross margin or operating margin over the past year. I don't know if we're going to push much higher, but this has become a company that is predictably profitable. And if you want to see why investors are so excited about this stock, like I said, I was covering Spotify in spring of 2023. This is when I started acquiring shares. They had very little free cash flow to speak of at that point, but everything was in place. They were growing their subscriber numbers. They were starting to increase their prices, and they had already implemented a number of layoffs, particularly in Europe, but those take a while to go through the system. So the savings, the increase in cash flow that you would get from all those improvements didn't actually hit until 2024 and then into 2025. Now we have steady improvement in the cash flow business, and investors are actually looking at this as something of a safe haven investment because people aren't going to cancel their Spotify subscriptions. So this is going to be a company that can continue to churn out cash. I don't think it's necessarily going to be another 10x stock over the next decade, but if it doubles, it will be a 10x stock, an asymmetric return for the asymmetric portfolio. That has helped drive returns because this is the biggest holding that I have. Number 2 is one that I covered in spring of 2024, so a little over a year ago. A lot of volatility in Hims and Hers, but you can see here that just phenomenal returns, about 350% returns over that period of time. I've just been slowly adding to my position in Hims and Hers, and I think this is a company that can continue to perform extremely well because you have a phenomenal growth rate, 5-year growth rate on a compound basis, almost 80%. And yet the enterprise value to sales is just 7. Hims and Hers is building a platform in healthcare. They are going to be the company aggregating demand. They are the touch point that consumers are going to use to reach other companies. A consumer is not going to go directly to Eli Lilly or Novo Nordisk for most of their healthcare needs. Yes, those options are becoming available, but that's a little bit like Craftsman saying we started a website when people were shopping on Amazon. You want to be Amazon in that space. You want to be the place where consumers are choosing to go for their healthcare needs. That's what Hims and Hers has become. That's why this is such a phenomenal growth company. And the growth numbers are just out of this world. You can see I'll layer in the revenue growth change and move this to trailing 12-month numbers. You can see over the past year, got into $1.8 billion in revenue, and that growth rate is 86%. Even when they dip down here, 50% growth rate in June of 2024, that was in the trailing 12 months. So that was when I started acquiring shares. We didn't know at that time that they were going to get into the GLP-1 business, but that's obviously been a huge tailwind for them, and I think it's going to be for the next decade. But here's the big thing that's happening at Hims and Hers. Their operating margin, which is this orange line here, has improved extremely quickly, and management has said that operating margin can improve 1 to 3% per year for the foreseeable future. So by the end of the decade, this could be a company doing in excess of 10, potentially even over 15% operating margins. That has helped drive their net income from losing money to making money. The concern that I had, even when I started buying Hims and Hers, was the company on a customer acquisition treadmill where you're spending $100 to acquire a customer that's only going to generate $90 in profit. That was the fear with any of these companies that are doing a lot of digital or online advertising. I think we've shown over the past year, Hims and Hers is not on a customer acquisition treadmill. In fact, they should probably increase their spending and increase their growth because those customers are getting more and more profitable. They're becoming more sticky as the platform grows. That's a phenomenal position to be in. That's one of the reasons that the stock is up as much as it is. Investors are really starting to understand the strategy behind Hims and Hers even more. I think this is a company that could 10x over the next 10 years. This will continue to be a stalwart in the asymmetric portfolio. And the third one that has helped drive returns is one that I added not all that long ago, but it was in fall of 2024, but has just been on a phenomenal run. That is Robinhood. If we just look over the past year at the percentage change, 210% returns for investors. This is when I started buying shares of Robinhood. And what's changed for Robinhood is really, I think, the stickiness of their business. This is not just a YOLO trading platform like it was during the pandemic. This is their biggest sources of revenue. Again, this is the KPIs from FinChat. You can see in 2021, this was a company that was driven by options trading, cryptocurrencies, and equities trading. That was a vast majority of their revenue. But what I got interested in with Hims and Hers was their gold product. That was a membership product. It changed the economics of things like credit cards or having retirement accounts with Robinhood. Made it much more economical for those of us who just don't necessarily want to trade a lot, but want to have the best brokerage experience. That made a lot more sense on Robinhood, and you got a lot of benefits from being a gold member. I get 3% cash back on everything that I spend with my gold card. So that shows up in things like net interest revenue. That is now the company's biggest single revenue source. Yes, options are a big deal. Cryptocurrencies are a big deal, but these non-trading revenue sources are becoming a bigger and bigger piece of the business for Robinhood. I think of this as Robinhood growing up as a business. They're doing much more mature things. They're now offering financial services products. So you can start a Robinhood account and then have an artificial intelligence advisor that's relatively inexpensive, much less than you would pay a human advisor, actually manage your portfolio for you depending on what your goals are. That's the kind of services that are going to disrupt the traditional financial ecosystem. I think that's going to help grow Robinhood's business long-term. Yes, it is a very expensive stock. And this is one of the things that I'm concerned with going forward. Haven't bought shares in a little while because we already PE multiple of 43. Forward basis, that PE could come down a little bit. We'll see what the growth numbers look like. But analysts are expecting earnings to actually come down a little. Their enterprise value to sales multiple doesn't show up here, but that multiple is about 20. So this is a very expensive stock. But again, I don't have to buy at these prices, but my portfolio can benefit from the gains in Robinhood. And sometimes that multiple expansion is going to be the biggest beneficiary you're going to have owning these stocks that can compound year after year. But what am I buying now? What is the stock that has got me the most excited? It's not a big name like some of the ones that I've talked about here. It's actually a stock that's a little out of favor in the market, and that is Lyft. Lyft is actually down 60% over the past 5 years. Even over the past year, not a great performer. Stock hasn't really gone much of anywhere. But what am I excited about with Lyft? This is a relatively small company, just a $6.6 billion market cap. But look at this enterprise value to sales number, 0.9. Uber's trading for about a 4 times enterprise value to sales multiple. So just multiple expansion could increase the stock value by about 4x if it just is the same as Uber. But there's a lot of operating trends that I really like about Lyft. These are trailing 12-month numbers where it's applicable, and they're since 2022. So you can see in orange, we have gross bookings. Those are growing steadily, compound annual growth rate of 15%. You don't get a lot of companies that are trading for 11 times earnings and are growing their bookings at 15%. Active riders are increasing, and the number of rides is actually increasing even faster than that. They also announced a $750 million buyback program that could reduce their shares outstanding in excess of 10%. And Lyft is now a positive cash flow company, generating almost $1 billion in cash just in the past year. They bought Free Now, which is the European operations recently. And here is the 10x upside for Lyft. Autonomy is going to be the future of transportation. And I think the value position to be in is not making vehicles, it's connecting riders with autonomous supply. That's what companies like Uber and Lyft do. So I own both of those companies in the Asymmetric Portfolio, but the reason that I'm buying Lyft is because I think they have an easier path to autonomy. They have partnerships with May Mobility that's going to be launching later this year. Also with Mobileye. Mobileye is a technology company, a modular company that is in millions of vehicles all around the world. They make the simple systems with a single camera, single chip that allow for smart cruise control and lane assist. But they're building level 3, level 4 autonomous driving systems, and their vehicles are going to be Lyft enabled. Basically, you could buy a vehicle, or a fleet operator could buy a vehicle and just plug it into the Lyft network. Think of this as Tesla's vision, except instead of going to the Tesla app, you're going to be going to the Lyft app. And these are operators that are already testing those vehicles with a safety driver in the US and in Europe. I think there's a clear path to Mobileye's vehicles becoming much more common, not only in the US, but also all around the world in coming years. And that supply could end up on the Lyft network. They also have their Flex Drive subsidiary that's going to help operate those vehicles, keep them charged, keep them clean. That's going to help fleet operators. So I think the path in autonomy is having that demand for rides. And if they can match that with growing supply of autonomous vehicles, that's the 10x upside. It's going to grow the market overall and could help Lyft take market share. And in the meantime, investors are getting Lyft at a phenomenal value, just 0.9 times sales. Price to earnings multiple on a forward basis is just 13. I love the value and the growth opportunity at Lyft. So look for that one to be a leader in the asymmetric portfolio long term. Now, if you want more from me, if you want to know what I'm buying every single month, sign up for Asymmetric Investing. Love to have you as part of that community. And if you want to do more of your own research with these tools that I've been showing here, check out finchat.io/ASYM. Like I said, you can get started for 2 weeks for free, and then you can get 15% off if you like it. I think you're going to love it because it has everything you need to be a fundamental investor. So let me know your thoughts on those 4 stocks, and Lyft in particular, the one that I'm buying the most of in 2025. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.